Good day, viewers. I'm Binette van Wyk, Head of Distribution at Catalyst Fund Managers. This morning, I'm joined by Theodore Frazen, a Senior Investment Analyst of our Catalyst Global Real Estate Users Fund. In our Q3 Global Dashboard, we will be discussing some of the risks and the opportunities, as well as an outlook for the global listed property sector. Welcome to Theo. All the way from London. I believe you still have a little bit of summer left on your side, and you're in Cape Town. It's summer is peaking out. Theo, maybe we can jump right in. If we look at the FTSE EPRA Nareit Global Developed Index, quite a widely followed global benchmark. This benchmark has returned circa 23 negative return over the last 2 years. Can you maybe explain to us the key reason for this underperformance of the benchmark?
Hi, thank you, Binette. That is a good question. Well, the increase in inflation has led to higher interest rates, which in turn means higher bond yields, and that is a negative impact on property valuations. In addition, the higher interest rate also means higher financing costs for companies, which means lower cash flows. So on a net present value, companies are worth less. Then the listed real estate space obviously is liquid. The securities trade daily, so the market was quick to incorporate the forward-looking effect of higher interest rates into the valuations of companies.
Thanks, Theo, for putting that into context to us. However, as we know, the same cannot be said for the private real estate market, due to the fact that the valuations lag, due to the backward-looking nature and the infrequency of the appraisal-based valuations. Furthermore, we are all very familiar with the headlines about the financial distress in the commercial real estate market. The majority of those headlines are all related to the office sector. I think it's important to share with our viewers what the difference is between the outlook for the private real estate market versus the public real estate market, and even more specifically our fund when we look at the office sector.
Thanks, Binette. The headwinds for the office sector is well known. With more people working from home, the demand for office space has decreased. The listed real estate market has roughly 10% exposure to offices, whereas in the private market, this makes up the bulk of the investments, together with the residential sectors, industrial and retail. Now, in our fund, we hold less than 3% in the office sector. The big difference, I would say, is that the listed real estate space has higher quality assets on average, but the private market is definitely higher levered. We have got lower quality properties that have a lot more leverage on them. So that is the key difference between office space in the listed and the private market.
Thanks, Theo, for putting that into context for us. Given that the fact that the office sector is so small, I think a lot of people often lose sight of the fact that there are so many other sectors within the global real estate sector that actually have positive tailwinds. And I think let's focus on that for the moment. So as we know, the balance sheets of listed REITs are actually looking very healthy at the moment. On average, their loan to value is sitting at roughly 30%. 90% of their debt is fixed, with an average term to maturity of roughly 6 to 7 years. Let's now turn to the private market. What do those numbers look like within the private market listed real estate sector?
Firstly, the public REITs have really learned lessons from the global financial crisis by employing a lot less leverage, but also extending the duration of the leverage and having a higher proportion of the debt fixed, as you say, currently around 90%, and also increasing the sources of debt using bank debt, but also bonds and private placements. Now, the same cannot be said for the private real estate market, where a lot of players have used the cheap interest rate environment and cheap debt to bid up properties by outcompeting with listed players. On average, private real estate funds or private real estate investments employ leverage levels between 60 to 80%. And according to Nareit, the North American Real Estate Investment Trust Association, the the term of debt for private real estate is on average 3 years. That compares to the 6 to 7 years that you mentioned. And the portion of debt that is fixed is only about 50%. Contrast that to the 90% as you mentioned.
Theo, let's turn back to the public market real estate sector. And let's just for the moment exclude offices. What are the operating fundamentals looking like for the other sectors within our universe?
On the whole, I would say property operating fundamentals are quite healthy at the moment. We are seeing decent demand for most sectors, and then there are some sectors that are experiencing strong demand, sectors like data centers, industrial, manufactured housing, and single-family housing. And then on the positive side of the higher interest rate environment is that developer financing has meant that there's been less development, and construction cost increases also means that the supply of real estate has dropped off. So overall, fundamentals, excluding the office sector, as you said, is relatively healthy.
Theo, let's turn to a quick comparison between the S&P 500 and the global listed real estate sector. Can you please share some detail with us, focusing on the following two key metrics? Let's look at the latest reported earnings results as well as the consensus earnings growth expectation.
Yeah, according to data from FactSet, at second quarter 23, the earnings growth year over year for the S&P 500 has been negative 4%, so earnings decline of 4%. Whereas for the same period, the real estate subsector of the S&P 500 had earnings growth of just over 10%. Now, if we turn to the dividend yield, the current dividend yield on the S&P 500 is roughly 1.5%, whereas for the listed real estate space that we look at, it's just over 4.6%. Now, looking forward, the consensus earnings growth expectation for 23 for the listed real estate space is about 4% earnings growth, whereas the same number for the S&P is roughly 1.2%. So the real estate sector definitely experiencing decent earnings growth compared to general equities as measured by the S&P 500.
Theo, and then last but not least, we know that unfortunately the global listed real estate sector has recently faced some challenges. What is your outlook for the global listed real estate sector in the foreseeable future?
Yeah, as we said earlier, the higher interest rate has already led to a derating of the listed real estate space. But the general expectation is that we are closer to the end of the hiking cycle. So we think that here on forward, most of the prices have already incorporated the higher interest rate environment. On the whole, fundamentals are good. We don't really see any mismatch between supply and demand. On the supply side, again, as we've mentioned, higher construction cost and development financing cost is leading to lower supply. The demand will always depend on the strength of the economy. There are certain sectors that are doing better because they're structurally undersupplied, and then the office sector not doing so well, but that's a small segment of it. Balance sheets are generally in good health, so we overall don't foresee stress happening in the sector as a whole. Here and there are specific companies that might be in trouble, but they are definitely the outliers and not the norm. Now, the sector currently yields free cash flow or FAD, funds available for distribution, of roughly 5.7%, and the expectation is for this to grow at higher than inflation. So buy and hold investors can expect to receive a real return of above 5% from the sector going forward.
Theo, thank you so much for sharing your valuable insights with us today. To our fellow investors and viewers, thank you so much for tuning in. If you'd like to learn more about the global listed real estate sector, please refer to our full Q3 2023 dashboard, or alternatively, please reach out to me as per the contact details below. Goodbye.